Hey, welcome. This is Tom Bentey Media, episode number 4. I'm here with my good friend, um, fellow tennis expert, Seaside Heights resident, Toms River native, a financial advisor at Mint Financial. And I wanted to bring Sam on because what's going on with GameStop kind of alarmed me in terms of how they're manipulating the market. I'm not an expert with finances by any means, but I'm just interested to learn a little bit more about what's going on, particularly with GameStop. And also, I understand there's AMC stocks involved. And I wanted to bring Sam onto the podcast to talk about it, to give a layman's perspective of, how this is unprecedented, and also if there's any way that the general public can take advantage of it. And also, I want to get Sam's input in terms of what we can do to start saving. If you're just getting into the workforce, you have some money coming in, and you want to maximize your results with financial planning. Sam's an expert with that. So, Sam, thanks for coming on, man. So this GameStop thing, I'm hearing a lot about it in the news. What exactly is going on?
Well, Tom, first and foremost, thanks for having me on. I really appreciate the opportunity. And no, you bring up a good point and a lot of good questions. So GameStop right now has been the hype over the last week, along with some other names. You had mentioned AMC, the movie theater chain, and then also Naked Brands is a company that I saw come across my screen. They own like Fredericks of Hollywood and stuff like that. BlackBerry and a couple other names as well. Even American Airlines was involved for a while there. So a lot of these companies, the common theme is that they had a lot of short interest built up around them. And what that means is for the average person, we're usually going in to buy a stock or to buy up a company, hoping that the price goes up. So you want to buy something, for example, at a $20 price, and you're hoping that it goes to a $50 price and you make some money on it. There's also, hedge funds and other people out there in the market that bet against companies, and that's what they call shorting the market or short selling.
Like
So
the Big Short, like the Big Short, the film.
Exactly. So Big Short, the film. So they're making a bet or an investment hoping that the stock price falls. So it goes from 50 to 20 to 10. So in the example of GameStop, a lot of these people who were following the stock, they were looking at what they call a short interest in the stock. And they saw that there was an extreme amount of short interest. So they decided to bet against the short sellers and buy up the stock. And what happens is, there was some good news that came out around GameStop, and then there was some other interest that got involved. But a lot of these social media companies, the chat rooms, and some of these online video sites, they started to really promote the stock for the retail investor. And when I say retail investor, I mean outside of the hedge fund world and the C-suite type of investors on Wall Street. I mean retail investors like the average person. They really got involved. They put a lot of money, behind GameStop and invested in them. And what happens is it causes a short squeeze in the market. So anybody who is short the stock, if it starts to go against them in the opposite direction and the price starts to move higher, they need to cover their short position. So now they're going in and they're buying up stock. So all of a sudden you have this price movement that seems unrealistic in a certain stock where it shoots up substantially. So in GameStop scenario, you saw it go from $12 a share, let's say, all the way up to where it's over $300 a share now.
But essentially what you're saying is these big hedge funds like Morgan Stanley, they came together. They thought that GameStop was a failure. They wanted to bet against GameStop. And then the general public, fans, I guess, of GameStop, or people that have an interest in seeing GameStop succeed, all banded together via social media on Facebook groups and Reddit. And they started basically going against these big hedge funds.
Essentially, yeah, you kind of had that type of a play happen here where they were saying, why can't the little guy get involved and make some money here on these trades? And you had a lot of these chat rooms like Reddit and other social media, avenues in terms of Twitter and possibly Facebook and stuff get involved. So from my understanding of it, a lot of these chat rooms or people that had a lot of following were out there saying, hey, let's get involved. let's get this thing, going. Let's make some money here. And that's what really brought the craze in this week into going into, GameStop, AMC, those type of names this week that you're seeing in the news.
Now, I also saw that Robinhood, which is, I guess, an app that you can do financial or stock purchases on.
Right. Yeah, so Robinhood's an app where you can, you should be able you can go out there, buy and sell your own stocks, on your own. Yep.
And they put a stop on individuals, not the hedge funds, but the general public, basically purchasing these stocks, correct? The GameStop and the AMC.
Right. So from my understanding of it, they put a restriction on there yesterday, which there was a lot of backlash about that, because what they were essentially doing is stopping someone from going into their own account, using their own money to purchase certain securities. And now whether, that was something that was told to them by the regulators or not, I'm not aware of at this point in time, but I know that there was a lot of backlash against it. And it wasn't just Robinhood either. It was Ameritrade, Schwab, Interactive Brokers. There was a few platforms that for a while restricted, the purchase of some of these securities.
Now, is that unprecedented?
It's unusual. Like I say, I don't know if it was the regulators that had stepped in at a certain point and told these companies not to do it, or if it was just their legal teams. But there's other things to understand in the background of this, is that these companies have investors as well. And some of those investors, from what I've heard on the news, some of those investors might have had investments within these hedge fund companies who lost billions of dollars on the short positions that they had on these stocks too. So you always wonder, is there something else going on behind the scenes where these larger companies or these hedge funds had money invested in Robinhood, had money invested in some of these online platforms, Interactive Brokers, Ameritrade, and did they stop this? Did they stop the purchase of these stocks to allow the shorts to be able to just, cover their positions or get out at the lower price instead of, the higher price if people were to continue to buy it? So you always have that speculation as well. On the other hand, so there's two ways of looking at it. The retail investor feels, well, wait a minute, this is my money. I'm responsible for my money. Let me determine how much risk I'm going to take in my portfolio, and let me buy and sell whatever I want. But then there's the other side of the coin too, is where from a risk perspective, are these companies trying to either mitigate their own risk in terms of margin? Because when someone buys something on margin, they're basically borrowing the money to go out and purchase a stock or whatever it might be. So if they lose on that trade, they have to go ahead and give that money, get that money back to give it back to where they borrowed from. So are these companies trying to protect the individual investor, by not getting them blown up in something that's up at $300 and all of a sudden it falls to $200? So there's kind of two ways to look at it.
Well, I mean, do you know what Robinhood's official explanation is for not allowing the general public to purchase these stocks?
From what I heard the CEO say on CNBC, it was something around the fact that, they were doing it from a risk perspective, in terms of, not seeing investors, hurt themselves with, investing and seeing the price drop on them dramatically. So it seems like they were trying to do it to mitigate risk. But again, you're telling someone that's a customer on your platform that they can't use their own money to go in and buy something in the free market. So it's you can kind of see the two sides to it.
Now, are there other avenues that individuals can take to purchase these stocks besides the apps that are not allowing them to do so?
Well, of course. I mean, if you work with a financial advisor, or if you're on a platform that allows you to, trade, I only heard a few of these platforms being shut down. So, for example, if we had someone call in, we could have, made the order for them. But, whether it's right or wrong, what it really comes down to is understanding your goals, your objectives, your risk tolerance. It really comes back to the overall financial planning to begin with, and understanding risk. Can you afford to lose the money that you put into one of these stocks is what it really comes down to. So if you were owning this since 15 or $20 a share and you rode this up to 300, well, that's fantastic. But now if you were to get in at, $300 or $400 a share, can you afford to take a loss if this thing goes back down to $100 or $50? That's where you really got to come in and make an informed decision for yourself.
Yeah, I think what's interesting too is how government officials are getting involved or giving their take on it. And from what I saw on the news, you have uh, AOC from New York and Ted Cruz actually agreeing that Robinhood should not allow or should not put restrictions on what people can purchase and what they can't, which I think is, very rarely, obviously, are those two going to agree on anything. And yet they agree on this issue, that they don't feel like Robinhood should be able to put restrictions on what people can purchase and what they shouldn't be able to purchase.
Well, you make a great point. That's probably the first time we'll ever see them, agree on something together. So I don't believe, that anyone with their own money should be restricted from doing what they want to do, but again, from a risk perspective, if they want to take on that risk, they should be able to do so. It's just you don't want to see anybody get hurt at the same time and bet the mortgage on it for the month either and put themselves in a bad position. So like I said, I could see where both sides are coming from, but hey, when they're agreeing on allowing the free markets to trade and not step in, I have to, agree with that point as well.
Here's a question for you. Is Robinhood a publicly traded company?
Not yet. There was talks about them going public, and I believe they were trying to do something for this year in 2021, but, we'll see what that has to bring.
Yeah, because I would be interested to see how their stock would respond to like what they're doing in terms of the restrictions. How do you think this is all going to play out?
I think you'll have some inquiries, definitely from the SEC, which is the Securities and Exchange Commission. You'll have some regulatory bodies get involved. You've already seen, like you mentioned, Cruz and AOC, they were talking about this yesterday. So you're definitely going to see some, at least investigating into what was going on here. Whether there was anything done wrong or not, I guess, we'll have to wait and see what the details show, but I'm not really sure how it all plays out. I mean, I'm sure we'll get some color as to, are these platforms allowed to block a customer / investor from deploying their own funds into an investment or not? I guess that's one of the positions we'll have to see how they take on it.
Yeah, it'll be interesting to see. There's a lot of hype around it at this point, and it'll be interesting to see how it all comes together and plays out. But let's talk a little bit about, more generally speaking, financial advising. And if you're somebody that's just getting into the workforce, you have an income coming in, what are some tips that you can do to maximize your results from a financial planning standpoint? Is there any advice you can give individuals that are looking to get into financial planning, that have no experience with it, that don't know anything about finances or the stock market? What are some things just a regular person that's not a multimillionaire, has millions to invest, that's just making a salary, what can they do to ensure that they're maximizing their savings for the long term?
Sure. So that's a great question. And we get it quite often. And you have to always remember that most people that are millionaires now, or even billionaires, they didn't start off that way. They started off with, some of them with nothing, and some of them maybe a couple of $1,000s. So you always need to work your way up. There's usually no quick way of getting there, unless you're buying thousands of shares of GameStop at 12 and you get that lucky chance that it goes to $300 or $400. So, the best way to really go about doing it is take a piece of your paycheck or your income for the month or for the year, and always make sure that you're putting something away. It's never too late to get started with investing for your future. IRA accounts are a great way to save and grow your money tax deferred. An IRA is an individual retirement account, and you can, put a monthly savings into that. You can make a yearly contribution, and that's just one way to start saving. And you make that contribution, you invest it into the market. You should really understand your own goals and risk tolerance for the money too, based on your age. So when you're younger, in your teens, 20s, 30s, you can be a little bit more aggressive if you're earmarking that money for retirement, which means that you're not going to touch it for a while. So you can let that money grow. You can deal with some of the volatility in the market, the ups and the downs, and you can be a little bit more aggressive with the investments. As you start to get into your, 40s, 50s, 60s, you may want to dial back the risk a little bit and start to make it a little bit more of a moderate portfolio, knowing that, retirement may be coming in the future. And then as you transition into retirement, you start to make it a more of a moderate to a little bit more conservative type of portfolio. So you're preserving those assets and you can use them and generate the income that you need to live in retirement. So it really comes down to a conversation, sitting down with a financial professional, making sure that you understand all of this and make sure you understand the way that the market works too a little bit. Educate yourself on or get educated. That's what we do. We help educate our clients in terms of, what are growth stocks? What are income producing stocks? What are bonds? What are different financial instruments that you can invest in, and how can you diversify and build out your portfolio?
Yeah, that's really great advice. I mean, something that I didn't realize until I was much older is, I guess, when you're a kid, your parents and older people at that time, they always would say, oh, just invest or just put it in a savings account. But as I didn't realize this until I was like in my 20s, that you're actually losing money by putting money into a savings account, because what the savings is like 0.1% you're making a year, and inflation is what, 3% a year?
Yeah, I mean, right now with interest rates at historic lows, the banks don't really have too much to offer in the savings accounts right now.
And so, yeah, by putting your money into a savings account, you're actually losing money in the long term.
For sure, yeah, because a lot of these banks, they take their deposits in, and it's in these bank accounts, and they essentially lend out the money in terms of mortgages and things of that nature, and they can be generating a 2 or 3 or 4%, interest rate on that money that they're lending. But yet they only give the person that has the bank account with them, maybe if they're lucky, a 0.5% or 1%. And in the grand scheme of things, where is that really going to get you? When you think about inflation and you think about all these other things, healthcare costs rising, education costs, and things like that, a 0.5% and 1% get you nowhere. And if you look back historically, the past 50, 60 years in terms of the stock market, the S&P 500, I'd say the average return is somewhere around that 9 or 10% range. So that's why, from a financial planning standpoint, you should be invested. You should have something invested in the market, because those type of returns you're not going to get from just sitting around in a bank account, and that money and compounding returns and compounding interest over time, especially in a tax deferred account like a retirement account. I mean, it could mean a world of difference when you go to retire.
Gotcha. And how is the stock market doing right now in terms of its viability and its health overall? I know back when the pandemic started, so we're in almost February 2021. Back when the pandemic started in March of 2020, it crashed, which is not completely unexpected because the whole world is upside down. But then it came back relatively quickly. And I think from what you were telling me, it was a lot because the government was pumping money into it. But it seems like it stayed. It's staying consistently high. Now, do you think eventually that's going to crash? Or what's your viewpoint, February 2021, of how the market's doing? And do you think it's going to sustain for this year and beyond?
So a couple of things here. So there's a couple of points there to be made. So last year, going into March and April, we've seen a historic V-shaped recovery from the beginning and to now with this whole COVID pandemic that we're going through. So a V-shaped recovery, I mean that the market literally went down and then shot right back up, and we're actually at new all-time highs right now in the stock market. So when COVID hit, it's always scary to see the market down by a third, right? When you see it, the S&P 500 is down 25, 30%, it always makes people worried. You know, it gets them scared. They're seeing their savings go down. They've never seen it go down so much in such a short window of time.
But
That's
that's when
really
you
the
should
best.
buy. Yeah, I'm sorry.
Exactly. So that's really the best time to have some dry powder, like we like to say, have a little bit of cash on the sidelines and move in and either buy more of the positions you own that you like, or just go and buy some new positions, because that's really a good time for you to take advantage of the situation right then and there. So from, I'd say about, midsummer on through the end of 2020, we had this, historic rebound off those lows. And now here we are, we're at new all-time highs here. And things are they feel like they're getting a little frothy. So we might be due for a little pullback at some point in time. So whether it's a 10% pullback or a 15% pullback, it shouldn't be unexpected, right? The market doesn't just go up in a straight direction and never come down. So eventually we will get a little bit of a pullback, and you shouldn't panic over that. Perfectly normal. It's just the market adjusting. At the same time, I've been getting a lot of questions from clients. What do you think about the new administration and this and that moving forward? The way that we look at it right now is that there's a couple potential catalysts for the market to continue moving forward that we see coming over the next year. You have the vaccine rollout, which seems like, it's getting put out there more and more. So over the next couple of months, you're going to have more and more people getting vaccinated. They keep talking about the herd immunity. So hopefully by the summertime, we happen to get, herd immunity. And I think people are going to feel more comfortable to get out of their houses. Hopefully kids can get back to school and get back to normal. People are going to be vacationing again, traveling, and that'll kind of open up things with the economy. So that should be a positive. And then also, if they do another round of stimulus, anytime they do a round of stimulus, that's obviously more money going to people where they can spend it on certain things or invest it in the market. And that could be another potential catalyst to move the markets a little higher over time.
Cool, but it didn't seem like it really, well, it came back. So, I mean, do you think it's going to continue to just keep on expanding once things start opening up with just the general country in terms of the vaccinations and things? I mean, do you think it's just going to keep on going up?
Potentially. I mean, only time will tell. So it's hard. I wish I had my crystal ball. I could tell you exactly where we're going, but I do see some positives there with the stuff that I mentioned. I think when people can start to travel again, you're going to see some of these, travel stocks do a little better than they've done. The airlines have been really beaten up over the past year. A lot of people weren't really feeling comfortable with traveling and stuff. So I think it should help the market, and it'll kind of make you feel like you're going back to normal a little bit from pre-COVID times. So I think that should be a good boost. So yeah, I think that is a positive over the year for us.
Gotcha. And I want to talk about the AMC stock. We were talking about this yesterday in terms of how they basically got bailed out by some investors. And what do you think the future of the AMC stock is? And I mean, do you think it's going to come back to where it was?
So AMC for a while was on the verge. There was talks on the verge of potential bankruptcy.
Because
then
of the pandemic?
Sudden, what's that?
Because of the pandemic?
Yes. Yeah. Because of the pandemic, their theaters were shut down. They obviously, you're shut down, you can't bring in any money. So they were trying to do what they could do to survive through this whole thing. And, it was scary times for them for a little while. Then all of a sudden, they had some positive news come out. There were some investors that came in, and I believe, we're able to fund them a little bit to get them through these tough times. And so all of that was kind of a catalyst and a boost to their stock price, on top of all this other stuff going on with, the social media and these chat rooms and those type of things. So I think all of that together was what gave the boost to their stock price recently.
Yeah, I mean, I think it'll be interesting to see what happens to AMC and movie theaters in general. I've been saying this for a while. Like, it's really just those tentpole films like Marvel Avengers and Batmans and things of that nature that are bringing people in mass numbers. And those movies make billions and billions of dollars. But the general public is not going to the movies like they were even 20 years ago because of Netflix and all these streaming services, et cetera. So I think they need to make it more of like a media center, or have it more of like a film festival experience where they are able to bring in cast members, bring in crew members. They can have Q&A discussions, give insights to the actual production. So people really enjoy that stuff, and it will give more of a personal experience to be there live. So it'll be interesting to see what happens with movie theaters in general. A whole other discussion is what's going to happen to a lot of these industries as we move out of the pandemic. Are they going to return to where they were? Is the restaurant industry going to change? Is migration going to change? Are people going to migrate out of the cities? It's just going to bounce back to exactly the way it was. We have more people working from home. So, how it all plays out in the next couple of years is going to be interesting. I don't know. I mean, a part of me thinks it's going to be exactly the same as it was once we get everyone vaccinated, but a part of me thinks that there are going to be some changes with movie theaters. And I'm a filmmaker, obviously, myself. So, I would go to the movies. I enjoyed the dine-in experience. I know some people have issue with that, but I enjoyed that experience, not necessarily for the food, but I like the big seats, and it felt like going out, and there was a big, beautiful screen, and was able to watch some good movies there. But not a lot of people were doing that. So I don't know. It'll be interesting.
No, definitely. I agree with you too, 100% on the, the ways to bring people into the movie theater. If you made it a little more interactive, or there was something there that could engage the customer, the audience, more than just, hey, buy some popcorn and go watch a movie, I think that would be a great way to bring people in. It was the same thing I thought about Toys R Us years ago. How could Toys R Us innovate, being such an iconic brand? And, children loved going to Toys R Us, especially when I was younger. I couldn't wait to get into that store. I was busting through the doors to go and find the newest toy or whatever it was that was out there. If they could have done something, interactive that would have drawn crowds in, maybe things would have turned out differently for them. So yeah, I couldn't agree with you more in terms of the movie theater.
Yeah, well, it seems like the old way of doing business just was very consistent, and people were like those established companies like Toys R Us or Kmart. They were very adverse to change. They did not like kind of changing their business model. They did not like changing the way that they approached marketing and the way they approached just basically how they ran their day-to-day operations.
Right.
And one of the things I think you see is why these companies like Apple, Amazon, Google are so successful is because they're constantly changing. Their whole way of doing business changes constantly. Like their essence of being is just change, constant change. Where a lot of these older companies that fell off to the wayside, that was totally against what they were all about. They were about just consistency. They had a way of doing business, and they didn't care what the surrounding circumstances, what the context was of what was going on in the business. And that's why they ultimately failed. And the whole new way of doing business is just adapting and changing to the environment and being, very open to just a very new way of doing business. And that's why these companies are so big and so successful. And they always keep the audience in mind. Like their ultimate goal is to really benefit their end users. And that's what they're doing very well and very successfully.
Yeah, definitely. No, innovation is key, especially in this competitive marketplace that, we're in, and you need to adapt to change. If you're not going to adapt to changes and quick changes too, because I mean, with technology now, everything just moves a lot faster. So if you're not going to adapt to those type of changes and innovate, I don't know what the future really holds for some of these companies.
Gotcha. And lastly, Sam, if there's any just, stock tips that you can provide, things that you like that maybe you want to share with the audience.
Yeah, so I mean, in terms of like individual stock picks and stuff, I don't want to, get into any of the individual recommendations right now, but because it really depends on each person's, risk tolerance and objectives and goals and all that type of stuff. But, be more than happy to, help anyone that we can. Our typical, account or client has anywhere between 250,000 to 3 million of investable assets. They're business owners. Our usual clients are in the Ocean and Monmouth County area of New Jersey, but we are registered in 14 different states. We work with a lot of executives in the pharmaceutical and consumer goods industry. So, if we can help you in any way, feel free to reach out and let us know. Really what it comes down to is a conversation. It's really just a conversation to see how we can help, what you're looking to achieve over the short term, the long term, and then really coming up with a game plan and a strategy to help you meet those goals over time.
Very cool, man. Well, thanks so much. I really appreciate you coming on and giving us some really good advice and just your take on what's going on in the market right now. And yeah, man, I appreciate it. Thank you so much.
I appreciate it, Tom. Thanks a lot for having me.